The finance world can be a very complicated place. There are many different things that we need to be aware of throughout our financial journeys. It can be difficult to know where to begin when it comes to learning how to navigate our way through this journey. In a previous video, we spoke about how many of the financial elite are big advocates for continued learning. In order to help improve our understanding and continue our learnings, in part 2 of this video, we will look into more of the lessons learned from some of the books of these financial elite. And please remember, nothing that I say in this video is considered financial advice. Most of us know that assets are something that we want to acquire and that liabilities are something that we want to reduce. But for many of us, that is where our understanding of these topics ends. Robert Kiyosaki talks about these in both Rich Dad, Poor Dad and the Cash Flow Quadrant. In these books, Kiyosaki identifies the difference between these and how they impact our cash flow. As the name suggests, cash flow refers to the movement of money in or out of business or personal finance situation. For something to be considered an asset, it needs to have a positive cash flow. This means that it needs to be making you money. An example of this could be if we own a parcel of shares that pay regular dividends. If these dividends are larger than any brokerage or other associated costs of purchasing and holding the shares, they are considered to have a positive cash flow. On the opposite side of the scale, a liability is something that has a negative cash flow. This means that it is costing us money. Maintaining greater liabilities makes achieving our financial journey goals more difficult, as we need to divert funds to paying these liabilities down. An example of a liability would be if we borrowed $50,000 to purchase a brand new car. The cost of servicing the loan, insurance, petrol, servicing, and other costs all have a negative impact on your cash flow. This example of our car can be turned into an asset though. If you work as a rideshare operator, your car will allow you to bring in an income that can either offset or supersede the costs of the car. Kiyosaki says that there has always been some debate about these definitions in the finance world. Some of this debate comes down to the classification of your primary place of residence. If we are going purely by the cash flow definition, then it would be a liability. He does go on to state that it comes down to who is making the assessment. While our residence does not make us money, it does for the bank or the institution who covered the mortgage. In many aspects of our life, most of us normally side towards being defensive or offensive in our actions. Our next lesson comes from Robert Stanley's The Millionaire Next Door. Stanley writes that when it comes to our personal finances, our actions and assets require both defense and offense. Sounds confusing, right? Let's first look at our actions. We've spoken many times in previous videos about risk. Any financial activity will have some level of risk associated with it. This risk increases if we look to go after higher levels of returns. For most of us, our financial journey goals will simply not just happen for us. They will require action from us to achieve. But we need to ensure that we have a balance in our actions. Continued offensive actions can have the potentially devastating results on our journey. There will be many times throughout our financial journeys that we will be presented with an opportunity that for one reason or another is just not right for us. It may not be within our risk appetite, or it may not align with our financial goals or priorities, or it might just not be a good deal. Having a defensive mindset here can help us avoid potential setbacks in our financial journey. But what does Stanley mean when he mentions defensive and offensive assets? Offensive assets are often referred to as growth assets. These assets often do not provide a regular income for us. The value of these assets is realized through capital gains. An example of this is some technology company shares. Many of them do not pay dividends, but people can see significant returns from selling them after a period of growth. Defensive assets, on the other hand, are often instruments that provide a stable income over a period of time. The returns from these assets will generally be on the lower end of the scale in our portfolios. But as we previously have discussed, these lower levels of returns are often associated with lower levels of risk. Where we are in our lives and our financial journeys will often dictate the balance of offensive and defensive assets that we need. As we get closer to retirement or to achieving our financial goals, we often look towards a higher level of defensive assets, as we often require our portfolio to provide us with an income. Earlier on in our working careers, we can afford to have a higher percentage of offensive assets to achieve higher levels of returns. It is important that your portfolio has both types of assets. Taylor Larrymore, Mel Lindauer, and Michael LeBeau bring us the lessons of taxes in personal finances in the book The Bogglehead's Guides to Investing. How often have you read about high-worth people paying very little taxes? Taxes could be its own full video series, but in the book the authors discuss the importance of understanding the tax system. It will be different for every country that you operate in, and it is worth having a good accountant and often good legal advice to help you navigate through this. While it is good to have professionals on our side who can give us advice, it is important that we have an understanding of how we can use taxes to help us throughout our financial journey. Now, we are not saying that you should not pay taxes, but there are many lawful ways that we can reduce how much we must pay. This means that we can use more of our own money towards achieving our financial journey goals. We know that no one's financial journey will look alike, and that you should talk to your accountants about how to use taxes to your benefits. But some of the examples that could be discussed are deducting expenses of assets. Often when my accountant explains that something can be used as a deduction, my first reply is, I didn't know that I could do that. Has an investment not worked out the way you had originally intended and you've taken a capital loss? Can this loss be deferred to a year that would have more beneficial to your financial situation? Or are you in a position that a personal corporation or trust structure would provide increased returns? There are many different laws and regulations regarding income and expenses when looking into these structures. Some of these strategies may seem more advanced than many of us require at our current points in our financial journey, but by having an understanding of the tax system and being aware of these strategies, we know that we need to inquire with our professional advisors about them. This understanding will also allow us to do further research to see if these strategies may be suitable for us to utilize later in our journeys. In the book, The Psychology of Money, Morgan Housel highlights that there is a large mental component to personal finances. It is often easy to believe that our financial journey is all about the numbers, but as human beings, we are emotionally driven creatures. Housel states that investing in personal finances is 90% self-control. How many of us have gone into a shop and purchased something that we did not originally intend to buy? Having spent a large amount of my early career in retail management, I can attest to the power of impulse buying locations. We have spoken in previous videos about the importance of spending control in the early stages of our financial journey. This can be some of the most difficult self-control that we need to adopt. Let's use the example of our office coffee. Many of us, myself included, often indulge in this habit, often without even realizing that we are doing it. The average cost of a barista-made coffee in Australia is approximately $5. Now, while this might not seem like much, if you have one of these every day that you're at work, it starts to add up. We know that our financial journeys will take time, often over the span of decades. So, our $5 coffee each day at work over 10 years ends up costing us $13,000. This is not even taking into account inflation or potential earnings from compound interest. And this is just an example of self-control over something that many of us don't even realize we are doing. Housel may have a point about this 90% spread. Now that we have covered some more lessons from books written by those that are at the top of the financial world, we are continuing to grow our education. Hopefully we have found some more books that we would like to read or go back and read again as well. But our education does not stop here. The people who wrote these and many other books believe that continued learning is the only way to achieve our financial journey goals. So I hope that we can all continue our learnings together. If you found this video helpful, please subscribe to Forever Finance so you know the moment more helpful videos are uploaded. Please consider liking this video so it will reach more people with its help. If you have something you would like to see us cover, please leave a comment below. Thanks for taking the time to watch this video, and we will see you all next time.